Every banking executive is talking about AI ROI, but most of those ROI claims are accounting fiction, numbers that look impressive on a slide and vanish the moment a CFO audits them. McKinsey says AI could add to $340 billion in annual value to banking, and yet 94% of companies report no significant value from their AI investments. Welcome to AI Business Architect. We skip the hype and focus on value that is measured, audited, and defensible against the sharpest CFO in your room. In the next 8 minutes, I will give you 3 brutal truths about banking AI ROI and 1 financial equation you can take into tomorrow's strategy session. The first truth explains why most of those ROI claims are fiction in the first place.
This is pure boardroom language, not IT jargon. First truth, raw productivity is absolutely not profit. The MIT Media Lab found 95% of organizations see zero measurable return on generative AI. If a credit specialist finishes risk reports 10% faster, that saved time does not automatically translate to bottom-line revenue. Your employees simply end up with more free time while technology expenses skyrocket. Real, undeniable profit appears only when you aggressively restructure your entire enterprise workflow around that newly created capacity. U.S. banking productivity has fallen annually since 2010, while tech spending grew 9%. The largest technology investment in banking history went backwards. You must deploy agentic AI operating models to fundamentally alter how cash flow is generated, not just to make staff comfortable. Without a redesigned operating model, AI simply inflates your balance sheet. Deploying advanced AI on top of broken legacy processes guarantees financial failure. That brings us to truth 2. Real measurable AI return is strictly concentrated in 3 enterprise zones: risk intelligence, knowledge operations, and the decision layer. Zone 1 is risk intelligence. HSBC's anti-money laundering AI delivered a massive 228% ROI. That incredible return represents a 60% permanent reduction in compliance cases and 4 times more accurate threat detection. JP Morgan Chase's fraud system has prevented $1.5 billion in actual losses. Zone 2 automates complex knowledge operations. JP Morgan's Coin platform autonomously analyzes 360,000 hours of legal contracts annually, slashing devastating compliance errors by 80%. AI-augmented credit memos consistently deliver up to 60% productivity gains across commercial lending floors. Zone 3 is the human-in-the-loop decision layer. The undeniable future operating model is 1 human supervising 30 AI agents managing end-to-end workflows. Vanguard already reports over $500 million in strictly measured AI returns. What do these 3 zones share? Exceptionally high data volume, strict regulatory compliance, and a direct line to the income statement. Outside these critical disciplines, enterprise AI spending produces only hype. Third truth, aggressive operating model redesign is your ultimate financial multiplier. Banks bolting AI onto existing workflows might eke out a 5% gain. Banks redesigning architecture around agentic AI capture 20% gains or more. That is 4 times the return on the exact same investment. Full transformation produces a sustained uplift in return on equity. Early adopter institutions capture a 4 percentage point increase in return on tangible equity. Slow-moving banks risk irreversible market decline. Retail banks could unlock hundreds of billions in annual profits using AI agents, but pure cost savings will inevitably erode. Brutal market competition forces those efficiency gains directly to the consumer. We are entering a new phase of the fintech war, where agentic systems will determine the future of money itself. AI is a defensive necessity, not an offensive moat. The true advantage lies entirely in how you measure, govern, and deploy. A dollar saved through AI risk prevention is mathematically equal to a dollar of new sales. Strict AI governance, model risk management, and audit-grade documentation form a lethal competitive weapon, not a mere compliance burden. Mastering AI ethics earns your institution a measurable cost of capital advantage in public markets. Let us synthesize these truths into one singular boardroom equation. Never evaluate AI like traditional IT software. Treat your agentic AI system as a fully salaried, highly accountable digital employee. Total AI deployment cost minus 3 core savings must yield a strongly positive number. If not, your enterprise architecture is fundamentally flawed. Your technology vendors will promise the world, but your internal governance must verify every financial claim. These 3 savings must trace directly to your audited financial statements. 3 structural pillars heavily offset the initial deployment cost: avoided hiring, eliminated vendor fees, and protected risk-adjusted cash flow. Pillar 1 is avoided hiring. Planned headcount multiplied by the fully loaded cost of each eliminated role. Pillar 2 is ruthless vendor consolidation, demanding cost reductions before securing continued funding. Pillar 3 is perfectly protected, highly optimized, risk-adjusted cash flow. When immense positive financial value is securely locked into your core operating model, it immediately transitions from a theoretical projection into a concrete, highly auditable financial victory. If your final boardroom equation is not undeniably and strongly positive, you do not simply have a temporary budget overrun, you have a catastrophic architectural design problem. High-maturity organizations rigorously run formal, relentless ROI analysis on every single technology initiative before deployment. In this competitive environment, strict boardroom discipline is the ultimate market differentiator. This is unforgiving, objective mathematics. Remember our core channel formula. Artificial intelligence creates unprecedented operational speed. Deep executive expertise creates unwavering market trust, and rigorous strategic frameworks create massive competitive differentiation. The era of slow legacy banking is permanently closing. Banks ignoring agentic AI architecture today will absolutely not be able to catch up tomorrow. You must stop chasing empty technology hype immediately. Start measuring real, auditable operational return and begin aggressively redesigning your enterprise architecture from the ground up today. You will finally understand exactly how AI creates real, sustainable value, not through marketing hype, but through brilliant architecture, optimized operating models, strict governance, and flawless execution. I am the AI business architect, exclusively designing the future of banking with AI agents. Subscribe right now to master this financial transformation and rapidly secure your exceptionally dominant market position.